Okay, is this working? Hey there. So it's my third stream. Thank you to those who've watched my first two streams. Today I'm going to be talking about BFT, which is planning to merge with Paysafe. I'm going to do a deep dive at that, as well as talking a little bit about Crowdstrike, a stock that I've talked about in my previous videos. I talked about Crowdstrike. I did a very in-depth analysis of it. If you haven't had the chance to, I think it's still relevant today. I hope you guys could hear me. Wonder if there's anyone joined. Just give me 1 second. I guess I'm just gonna keep going until I see any issues. I think it's working. Okay, so let's do this. Okay, so we're gonna talk about, before I go to talk about Paysafe or BFT stock, I want to talk about Crowdstrike. So I don't know if you guys probably have heard about FireEye, which is another cybersecurity company. Their shares fell after a security company disclosed a cyber attack on December 8th, and then the stock kind of took a dive. Let's see where it is. Let's do this. FireEye stock. So this is their last month. So right after, is it the 8th? Yeah, so it's the 8th. So after that announcement, they took a deep dive, about 13%, and then since they've kind of recovered. And really the reason behind that is because they are a cybersecurity company, and because of these threats, there is a need, and I guess there is a need for cybersecurity companies, and that's why it kind of recovered very, very quickly. And just shortly after, just let me make sure this is working first. Give me 1 second. One second, I'm just checking with someone to see if it's working. Okay, so so they took a deep dive, and just a week after, and so just a week after, or maybe about 10 days after, or not even, about 8 days after, SolarWinds hack has shaved 23% from the software company stock this week because of a cyber attack again. So that is the reason kind of why Crowdstrike kind of been like around 16th, right? So right after that announcement, Crowdstrike kind of ran up from about $180 to today at $224. So it had a huge run. So that's about a 25% run. And from that time, then the first attack by FireEye, it's gone up about 26%. I really like this space because I think data is very important, and because now with the work from home, there is a move to shifting to cloud solutions, and now there's importance of securing that information. And Crowdstrike does it a very interesting way because they use cloud solutions, and they're continuously updating, fighting against this kind of breaches. So I talked about in-depth video on July, the last 3 months, 62%, July 23rd, where the stock was about $100, and so it has gone up a lot. I recommended it was a buy because I really like the business that they're in, and I love how they're capturing the market. And if you look at Crowdstrike's current year growth, it's 78%, like 80%. This is incredible, and they're expecting to go 40% next year, and I think 30% the year after. So I think it's a great business that they're in. I think there is a need for this business, and I think they are doing the right things. I know the valuation is very, very expensive. I talked about it in the video. So that's why I sort of bought, at that time, I told you guys I had about a third of a position. It's about 6 months ago. So around right here. And then I saw a dip below 100. I actually bought more around here, below 100. And then ever since, it just kind of climbed. I didn't get a chance to add my last third. So I bought 2/3 of my position. So I will probably add sometime. I don't know when. I mean, I won't be chasing it right now. I mean, it's gone up a lot, especially with the news on the breaches and the cyber attacks. So I like it. It's expensive. I will be adding, but I just don't know when. I'm holding it. I don't want to trade around it. I mean, if you're up a lot, you could perhaps take some off the table and take on some profit. But for me, I'm happy with my position size right now, so I don't want to reduce it. I'll just hang on to it through the ups and downs because I do think this is a important company that will continue to improve and do well going into the future. So I do like it. Let's see if there's any comments or anything. Hey Danica. Yeah, it's been a long time, eh? A few hours ago. Yeah, so thanks for joining my live show. Hi Nee, thanks for joining my live show. So the other thing I want to talk about today is BFT. So BFT is planning to merge with Paysafe. Just look at their stock quickly. So the current price of their stock is about $14. They announced it around beginning of December, around right here, and you see the huge jump, and then it's kind of doing well since then. So I want to do a deep dive into this company. This is the special purpose acquisition company that's planning to merge with Paysafe. And let's go through their investor presentation, and then I'll do like a valuation update based on the increase with their competitors, and just kind of conclude on what I think about it, what I'll be doing if I don't own any shares, will I be buying it? If I have any shares, will I be adding, etc. I'll conclude that at the end. So let's go through Paysafe. Okay, so these two are pretty important people. So Bill Foley is actually the chairman of Foley Transmine. So that is the BFT special purpose acquisition company. He actually has a lot of experience with creating, delivering stockholder value. We'll talk a little bit more about him later. And Philip McHugh, who's the CEO of Paysafe, with a lot of years of experience too. I'll go through this whole transaction overview after. I want to talk about the company, what they do first, and then I'll look at the financials and valuations, and as well as this transaction and what I think about it. So I'll go back here a little bit later. So again, Bill Foley is actually a very smart guy that has a lot of experience. He's led like 5 separate multi-billion-dollar public market platforms with over 100 acquisitions across them. Here it says that he is also the founder and former CEO, now chairman of Fidelity National Financial, built the largest title insurance company, growing equity value from 3 million to 11 billion. So he has helped the company grow from 3 million to 11 billion, which is pretty incredible. Similarly, through FNF, Foley was able to acquire a spin-out FIS with a current market capitalization of 91 billion. Black Knight, current market capitalization of 14 billion, and Canadian Investments, market capitalization of 4 billion. So this guy has a lot of experience in the M&A. If you could see here, mergers and acquisitions, for those that don't know, you can see how he's these are some of the companies he's been with and kind of worked on. You can see right here, they've been, significantly grown a lot. And here are some of the acquisitions that are previously, that were done, the cost savings and the synergies achieved. So this guy's very experienced in M&A, helping companies grow and cut costs and kind of help them, grow and be more efficient. So this is kind of this way of doing, or I guess his program or the strategy of how to grow business and cut costs and whatnot. So by acquiring a company, you will have a lot of there's going to be integration. So there's going to be maybe 2 platforms, 3 platforms. How do you integrate and kind of put them together into one kind of platform that's good for, I guess, everyone. So that's what and through that you find efficiency. So that's what he says here. Total project cost savings from platform integration, total project revenue growth strategy. So by having 2 different companies, perhaps when they combine, one could cross sell to the other. So that's a strategy in helping grow sales. What else? Another very important market that is upcoming is the iGaming market. It's growing very, very fast. So they are in this space. So another way to kind of continue to help the company grow. Here it says the M&A strategy. So through mergers and acquisitions, etc. Foley has a governance team with expertise in the transformative M&A. Foley track record of success, highly regulated industries. This is kind of what Foley will bring to the table with Paysafe. And this slide just kind of says how Paysafe is highly attractive and scarce investment opportunity within the payments fintech space, and is similar to characteristics to other Bill Foley's deals that he's done. So this one I talked about a little bit earlier. So in 2003, Bill Foley led on the acquisition of Alta Information Services for $1 billion, which later became Fidelity National Information Services. And today, that again, it's 91 billion. So he's kind of helped that company grow. So how? So operate in a highly fragmented industry. So when an industry is fragmented, meaning a lot of small players, and fully utilize the platform and technology stack to consolidate and drive organic growth and improve margins. So in just consolidating, making it bigger and improving margins and integrating through that, he's able to build, generate shareholder value. So that's what he wants to bring to Paysafe. Similarly, attractive platform with defensible market position, upside again from acquisition, integration, platform consolidation, and cross-selling. Multiple attractive acquisition opportunities will strengthen market position further. Position to win in key attractive high growth markets. Let's look at what Paysafe does. So Paysafe is they're highly differentiated between in the B2B, business to business, and business to consumer global network. So they're like a platform, like a network that provides digital wallet, e-cash, and integrated processing solutions. Those are the 3 main businesses that they have. We'll go through a little bit of each a little bit later. So they're saying there's significant growth in the opportunity of the massive TAM. They have a long history as a global market leader in iGaming payments, a great place to be in, and well positioned to capitalize on expanding U.S. market. U.S. is becoming more as they legalize or allow legal gambling through online. I think there is going to be a growth, just like with LCA or Rest Street, those or DraftKings, a great industry, definitely a growing industry. They have proprietary scalable platform technology, risk management driving, and proven M&A playbook. So I think there's a lot of concentration on merger and acquisition. So we will see more about that later. Clear 4-point strategy for growth transformation. So Bill Foley's kind of program, it goes through like 4 key points, and we'll go through those later. So like I said, there are 3 parts of their business. Their digital wallet are like network of digital wallet solutions that enable users to upload, store, withdraw, pay funds, and alternative payment methods from virtual accounts. So some of the key customers that they have, DraftKings, Bet365. So it's kind of like an online wallet that could be used for different purposes. And they have iGaming eCash network. So it's a proprietary digital currency solutions empowering online, mobile, and in-app commerce for gamers and cash consumers. Present in 50 plus markets. Like Fortnite, Twitch, Spotify are their customers. So some pretty big customers here. So looking pretty good. So independent merchant acquirer in the U.S. So Paysafe integrated processing. So integrated point of sales and e-commerce solutions for small medium businesses and e-commerce sellers to accept payments across channels. So similar to like PayPal or Square in that aspect, somewhat. Presence in across U.S., Canada, Europe. Some other key customers. So that's what they really do. It's got fintech, the online platform, integrated digital wallet business. Okay, so here is their I guess financial profile. This is their 2021 estimated financial metrics. I'm just gonna quickly check if there's any issues right now. Hey Chris, hey Cindy, thanks for joining. Okay, will I be buying Paysafe? I'll let you know at the end. Or do I have it already? Okay, so it's quite interesting. So so basically what they do is for customers to use this platform, there's going to be a volume of transactions, and they pretty much take a cut out of the a fee out of the transactions. So for example, like the whole company, let's say they have 103 billion, they take a 1.5% cut, so they generate 1.5 billion. So these are the three parts of the business that adds up to 103 billion, and these are the take rate for each of their businesses. These three parts of their business, and that's the average take rate. That's what they call it. So this is their revenues, totaling 1.5, and this is the gross margins, which, generally speaking, platform businesses have high margins because they're naturally not selling a good or something like that. They don't need to produce this good to sell. They're just kind of having a platform for users. Okay, creating a powerful, safe Paysafe network. Again, they're just saying here that they are both to consumers and to merchants, kind of playing both sides, B2B and B2C. Okay, we are a global leader in iGaming. So they launched in 1999 in Europe and the rest of the world. In Canada, they launched in 2010. United States, they launched in 2013. Their expected CAGR, or compound annual growth rate, is about 12% in the rest of the world in Europe, 15% in Canada, and 55% in the United States. As United States starts to legalize online gambling and iGaming, I think that's why it's increasing very quickly in the US. So integrated cloud technology. So these are just some of the things that they are doing right now or into 2021 and 2022. For example, migration to the cloud. They all want automated underwriting. They want to consolidate the wallets, single platform across different platforms that they have. And then payment processing, single onboarding for US small, medium business merchants, cybersecurity, very important, ongoing. Okay, global platform, risk and compliance, highly developed. So they've registered in many of the world, or different parts of the world. For example, registered in Canada with the BC, in Ontario, regulated by Alcohol and Gaming Commission. So they're pretty diverse, I guess global. So that, again, this is a global business company. So that's what this is. Paysafe playbook, expansion, M&A engine. So again, this is they went through 15 deals, 300 plus deal experience in management team. So again, I think that's one of the growth strategies, and we'll see that a little bit later as well. So attractive growth opportunities. So how are they going to grow? So here's the 4-point strategy for growth and transformation in partnership with Bill Foley, who is the chairman of the SPAC that they're merging with. So they're kind of combining and kind of taking I guess Bill Foley is kind of helping them to be able to transform and grow its business. Again, after you buy, you integrate, platform integration, accelerating existing organic revenue growth strategies. We will discuss this a bit later. I think we highlighted a little bit earlier. Winning in US iGaming, so they definitely want to capture this in their growth. And again, M&A strategy, and they just kind of continue to roll up. I guess they call it roll up. You know, when you buy and you acquire, you integrate and you do it again and you do it again. So one of the issues with that is there could be issues with integrating, and there could be issues like how it depends on how your cash flow is. Are you generating enough? Because if you want to acquire, you could either issue more debt to raise cash, or you could borrow and whatnot. So there is some a risk in M&A strategy. I mean, it is a way to grow. So I mean, that's their plan, and Bill Foley has a lot of experience in that. Other than that, there's opportunities to unlock over 100 million adjusted Ebitda, in additional to organic revenue opportunities and cost savings over 2 years. So instead, and not just growth, not just integrating, but integrating also saves costs. So that's what they're trying to do, not just cross-selling, which is one of the things they want to do. Like they said, enterprise sales. So one way to grow is through cross-sale, of course. And the other is to reduce costs, like optimizing legacy processes, technology, back office systems, like even being on one platform rather than so many different platforms is you would need so much more power, so much more resources to run multiple platforms. What else? Proven leader in iGaming, well positioned to be successful in highly attractive US iGaming market. I love the space that they're in. This is definitely a growth area. They even have a CAGR at 52% expected from 2019 to 2025. And there are a lot of iGaming customers that they're with DraftKings, Pennsylvania Lottery, Michigan Lottery. These are pretty well-known big organizations, so I think it's a great way for them to grow. And like not just that, through winning high growth and profitable markets. So they could be in gaming, social media, property management, wellness membership, just finding different avenues to grow. Because online payments and integration with wallets and etc. I think that is the future of future of fintech companies and being online and doing many things online, playing games, social media, perhaps property management and wellness and membership. So back to the acquisition opportunities. Again, across their different, they have three, so I don't know where they combined, but basically they could acquire companies. So I think that's what they're looking at. They're saying how like they could consolidate their digital wallets. Like there's over 300 specialized wallets globally. Again, it's very fragmented. Their opportunity to acquire the customer base, monetize them effectively. So growth by acquisition. E-commerce integration, e-cash, adding new markets, verticals, cost saving, or adding verticals like new stuff is a way to generate income as well. Cost saving opportunities, consolidation of back and processing volume, single API is processing interface, application programming interface, driving proprietary alternative payment methods and a single gateway to improve take rate. So yeah, another way to improve revenue is increasing the take rate. But when you do that, it's easier for competitors to come in. But if you're so big, then you're kind of on monopoly in a way. But they do have competitors. iGaming, again, great place to be in. So let's look at their performance and financial results. Oops, what am I doing? Well, that's not what I wanted to do. Oh, that's not what I do. Sorry. Just check the chat to make sure. Okay, keep going. Okay. Again, 103 billion. Like we talked about this earlier, in 2021 transactional volume, they take I think 1.6 or 9%. Take rate equals to 1.5 billion organic revenue in 2021. Expected to grow a growth rate between 2020 to 2023, 11%. That's slightly low. I prefer probably a higher growth. 11% it's not bad. I mean, it's pretty good. Better than putting money in the bank, right? If you can use it to grow 11%. Highly profitable. Ebitda margins 30%, 35%. These are pretty good Ebitda margins long term. Strong cash conversion, 80% adjusted cash conversion margin. So cash conversion margin is how much of the number can you get cash for the amount of income or revenue. Usually it's a part of revenue or income. I think that's just the Ebitda cash conversion. So for every dollar of Ebitda margin, they would earn 80% cash from it. I think that's a long term what they're hoping to do. Double-digit growth volume. As volume increases, when you have your take rate, you have an increase in your organic revenue. Volume is increasing by 15% while your revenue is increasing 11%. It's probably because you're having a smaller take rate, or your take rate is lower on the majority of I guess it's like a lower take rate, right? So 11% year over year between 2020 to 2023. So it's not bad, like 15%, 11% growth. So with that, as they grow, they will, as a operating expense as a percentage of revenue would decrease if you keep it constant. But if you continue to grow, of course, depending how much you're growing your expenses versus how fast you're growing your revenues. But they're hoping to kind of improve that. You can see here, as organic revenue increase year over year, operating expense will, as a percentage of revenue, would decrease. Yeah, I'm not sure how that works, but organic adjusted Ebitda. Looks like this is growing faster than the revenue, and this just means that they are somehow reducing their costs or not spending as much. They could still spend more, but the rate that they're going to increase their costs is slower than the rate that they're increasing their revenue. So that's why you have a higher Ebitda margin versus high growth on your Ebitda margin versus the growth on your revenue. This says how diversified their business is in different segments. For example, like this is the 3 parts of the business: processing, wallets, and e-cash. These are geographically. Rest of the world is 14%, North America is 38%, and North America 48%, Europe 38%. Their iGaming business is 34%, emerging verticals is 30%, and their small business, medium business is 36%. So a pretty diverse group of customers and geographically and segments. Okay, so they're pretty resilient to the global health issue that we've been having for the last, I guess, almost year now. So since January, it decreased to about 17% to 83 or 83% of organic revenue in April, but since then it's kind of rebounded. So they're slightly about 1% below their revenue from previous year, or from Jan to October. And again, similar to their digital wallets, it was let's say 100% January. It kind of decreased about 11% to 89% in October. But interestingly is that their e-cash has increased 30-something% since January. So they're not too impacted by the global health issue. So again, this is their 80% adjusted cash conversion margin. So so they're expected to generate 80 cents on the dollar for each Ebitda that they have. Okay, so organic adjusted Ebitda bridge. So this is just how they're growing their organic gross profit. I'm wondering if they're increasing margins here and decreasing expenses to have a higher Ebitda in 2021. And then this pro forma upside is represents upside based on planned 2021 organic adjusted Ebitda given a pro forma effect of cost savings and revenue opportunities. So this is kind of compared to its peers, Paysafe, PayPal, NVEI, PAYA, RPAY, Shift4, and some traditional payments services, Fiserv and Global Payments. So this, I would take it with a grain of salt. I mean, they always say, yeah, they have everything, but they're very, very small compared to like PayPal. So yeah, I mean, they're saying they're in e-commerce capabilities. They're a two-sided network, meaning B2B and B2C, vertical focus, global, and risk management. So these are just about the growth and their valuation. So 19% growth, and this is their EV to 20 EV to EV enterprise value to their 2021 estimated Ebitda. I'll do a more updated valuation a little bit later with these 5 companies and Square. So make sure not to miss out on that. I think that's a pretty interesting something to look at. What else? So they don't even have Paysafe valuation here, but we'll look at that a little bit later. So appendix. So this is actually very interesting here too. So it says Blackstone and CVC value creation since take private. So they were actually taken private by some PE firms like Blackstone and CVC. At that time, they had net revenue of, I think I have the article here. Blackstone CVC made 3.7 billion bid for payments firm Paysafe. So they paid 3.7 billion in 2017 for 864 million. Okay, and this year so they grew that revenue to 1.4 billion in 2019, and I think the estimate is also in 2020 is also 1.4 billion. If you go back to, sorry if this is too fuzzy. See, 2019, 1.4 billion approximate. 2020 estimate 1.4 billion. Okay, just remember that 1.4 billion. Yeah, so and representing a 27% compound annual growth rate. So they're able to grow their revenues from 2017 to 2019 at a 27% compound annual growth rate. But the issue is that I guess what I kind of thinking about is, well, why they're slowly growing afterwards. I mean, they're growing 11% estimated, right? So that's one thing I'm not very comfortable with or kind of thinking about. So let's look at their valuation. So I'll go through this one a little bit later. I need to update the price, but let's look at, let's say 3.7 million for 864 million of revenue in 2017. They're paying a price of about 4.28 sales multiple at the 3.7 billion valuation. So now, so now it's 1.4 billion. No, not 1.4 billion. Well, sorry, 1.4 billion. Sorry. So the valuation, I forgot to mention, is actually 9 billion for the transaction, and they have 1.4 billion of revenue in 2020, which is this year. So if I take that, so the multiple they're kind of on the transaction at 6.4, but your growth rate is only at 11% after. Before you're paying a high. So right now, what it seems like is in 2017, you're paying a smaller. A lower multiple for a higher growth versus right now you're paying a higher multiple for slower growth. So for example, like if we take revenues, this is the revenues, right? Revenue grows at 62%, right? But your value, so from 2017 to 2020, your revenues grew 62%, but your valuation increased by 1.4, which is 143%. So that's a little tricky for me. I mean, you could argue that, oh, we have Bill Foley that would generate shareholder value, or the 11% is conservative. So maybe it is. Maybe they would expect higher growth, maybe. But even higher growth, let's say 27%, I would want to pay the same valuation, right? But so that's something interesting to think about when I was looking at this deal. Right, 3.7 billion for payments firm. Become targets for credit card. Yeah. Let's keep going. invested. I mean, you could also argue they invested a lot of money into these key platforms. They upgraded, expanded their management. They spent over $1 billion on strategic and M&A. I mean, again, like how much you spend right now. I mean, I care more about how much you could generate in the future. I think, from a valuation standpoint. We have so that's this slide. Interesting. Yeah, I mean, think about it. Growing 62% from 2017 to 2020, but your valuation goes up 143%. Let's see. Hey Raymond. Hey John. Already bought into the SPAC. Got to respect the fintech space. Yeah, I mean, I think fintech is the way to go. I like fintech. But I do have some questions about the valuation, at least for this one. I mean, I like the business that they're in. What else? Enhanced geographic diversification. We have developed highly differentiated capabilities, proprietary, unique, smart. I'm just going over these quickly. I don't think it's too relevant. It's kind of similar to what they've said before. The e-commerce integrated commerce is 75% of the revenue. This is the experienced team. So that's the CEO. Again, they're highly differentiated, two-sided network, B2C, B2B. I like that. That's pretty good. Attractive global growth opportunities. I think there's definitely growth opportunity. Strong performance and financial results. I looked into this slide. I actually don't really understand this slide. It says detailed path toward organic revenue generation and cost savings. So is this the cost savings and this is the revenue it generates? Is that what they're trying to say? Again, these are the different things that they're trying to improve, like revenue for from cross-selling to being more efficient, to reducing costs and generating more money from it. Maybe that's what it means. There's their growth in the revenue and there's their cutting costs. This is their digital wallets, some of the key numbers. Take rate, organic growth, again, 14% here. I think this is their smallest part of their business. See, 441 and 14%. No, that wasn't their smallest. This is their smallest, eCash. Sorry, eCash. eCash is growing 8%. Sorry if I'm scrolling too fast. Just some key metrics. A bit more about their business. I'm going to go through the valuations soon. This is the processing business. The biggest part of their business, growing at 10%. Okay, so operational benchmarking. So this is the growth rate. Again, like for example, organic revenue growth from 2022 and 2021. So for example, like PayPal is growing at 19%, NVEI is growing at 17%, Shift4 is 21%. So these seem to be, a lot higher than what Paysafe is. I don't know if Paysafe is being conservative, but these growth rates are better than Paysafe. This is their Ebitda growth, and this is also their organic adjusted Ebitda growth, 2021. So the only one, like the growth rate growth rate these is better than Paysafe. Maybe something I'm missing. So also here, with the Paysafe valuation, so this is the EV to 2021 estimated organic adjusted Ebitda. I've done updated valuation. So now the price has gone up, so the valuation is different from what you're seeing here. But I will compare it to PayPal, NVEI, Shift4, RPAY, and PAYA, and also Square. I'll do that valuation after. I still have to go through the transaction details right after this. So this is their unaudited 2018, 2019, the revenue, the adjusted Ebitda, which is not bad, like 468 million, but they have like huge amounts of depreciation probably from the platform. They took an impairment on intangibles, So operating income is significantly reduced because of those. And on top of that, you look at these other interest expense. You must know that they have a huge amounts of debt on their balance sheet. The revenue is like, you're talking about 156 million, or let's use 2019 numbers, 164 million out of 1.3 or 4 million. You're talking about 11% interest that they're paying on 1.4 billion of revenue. GAAP to non-GAAP reconciliation. Nothing too much here. Okay. So let's talk about the transaction detail, and then we'll look at the valuation, and then I'll conclude on what if I own any or if I would be buying any. Okay, so the first slide. Okay, so here's what's interesting. Transaction value. So the pro forma equity value is at 7.1 billion with a pro forma net debt. So you get the enterprise value. So generally it's the equity value plus your net debt minus your cash to get your pro forma enterprise value. Enterprise value kind of strips out the cash and strips out your cash and debt. Just kind of say without these cash or debt, what's your real value? So that's 9 billion. I used that in the calculation here earlier. 9 billion. Let's go back. Where did I? Okay, so 9 billion. Net leverage to 2021 organic adjusted Ebitda. So this is how long it takes for your Ebitda to pay off your debt, your net debt. Pretty much that's what's saying here. So there's okay, so the SPAC, which is the fully BFT special purpose acquisition company, they have about 1.5 billion of cash. I don't know what this 150 is. I'm gonna ignore it. Pipe investments, they've got 2 billion. So a total of about 3.5 billion more or less. We'll ignore this for now. Existing Paysafe shows rollover equity. This just cancels with this, okay? So with 3.5 billion, what are they gonna do with it? They're paying down debt of 1.1 billion. Okay, so they have debt of 1.1 billion. So that's what the 164 million of interest is on, likely, on the debt. So with 3.5 billion, they're paying off 1.1 billion of debt. What's happening to the rest? Cash consideration to existing Paysafe shareholders. So they're buying out or paying out some shareholders with 2.3 billion. So that leaves them with, I don't know how much debt they have. I mean, but basically through the transaction, there's no cash left. It doesn't look like there's any cash left to the combined company. Now, I don't know the combined company, do they have cash? Actually, do they have financials? 1 second. I didn't really look into here. Yeah, there's no balance sheet here. So I don't know what right now Paysafe has, like how much cash they have versus how much debt they have. I don't know if this 1 billion, here pays off all the debt. I don't know. Maybe there's more debt. I don't know. So the question becomes, well, you don't have no cash anymore. Are you gonna borrow another 1.1 billion just so you could buy more, like acquire as part of the strategy that they're doing? So that's one question I have. I mean, if you're gonna grow through acquisitions in the future, how are you gonna finance the acquisition? So I don't know. So that's a question I have. Again, 13% growth, 17%. I mean, it's good, but not like spectacular. We'll compare these growth rates with the other companies that were compared. So after the merger, SPAC, and I guess this is the part of the PIPE, would own 22.5%. And the Blackstone and CVC and other shareholders own 45%. Bill Foley owns 4%. That's the guy that I talked about earlier in the video or stream. And then this is the PIPE shareholders. SPAC. I don't know why it includes these financial institutions or PE. Yeah, those are PE firms, I think. So I like what they're in the business, but I have questions about how they're gonna grow, and even though they have strategies how they're gonna grow, but how they're gonna finance their future growth. I guess it's cutting costs and maybe money from because this is a really high margin business. Okay, let's look at valuation then, okay? So I have Paysafe. Again, I gotta update these. Paysafe, PayPal, NVEI, it's a Canadian company, RPAY, PAYA, Shift4, and Square. So these were the ones they used in their valuation, in the comparison. So 1468, I'm just gonna update this quickly. And let's look at PayPal. Oops. For 243. 243.49. And let's look at NVEI, NVEI. 77.99. These were yesterday's valuation, yesterday's numbers. What was next? RPAY. 2790. PAYA. Just bear with me, I'm almost done. 1373. It didn't really change. 4. 7272. And the Square. 241. Let's see. 2.58. Okay, so I kind of extracted from the PowerPoint investor presentation. So this is their sales. Okay, before I go there, this is the share price, their outstanding shares, the current valuation. So right now, if you're buying Paysafe, they're actually 13.2 billion. So even higher than what you're, I guess, higher than the actual transaction value of 9 billion. So we're talking about 13,212. You're paying 2.57 times more expensive than what they paid in 2017. Okay, so yeah, these are their sales. So the price to sales valuation is basically market cap divided by their sales. This is in CAD. It doesn't really matter because these ratios are all. I mean, if this is in CAD or US, it'll be the same. The value, the ratios, it's not by, I guess, dollar. It's ratio. So it doesn't really matter if it's in CAD or US. So, and then I kind of look at their Ebitda as well, also from the investor presentation, and put it here. And then I got a price to Ebitda ratio. Probably better to use EV to Ebitda, which is enterprise value, because it strips out, like I said, cash and debt. But I didn't have enough time, but I just kind of like rough estimates, approximate, I guess. I just ignoring cash and debt. The valuation, and then this is the growth rate basically from taking their sales from 2020 to 2021 and 2021 to 2022. So you can see here for Paysafe, their price to sales ratio about 8, price to EBITDA about 20, growing at 10% from 2020 to 2021, growing 10.7% from 2021 to 2022. So not very spectacular growth rates versus like PayPal. PayPal trades a little bit more expensive in the price to sales, more expensive on the price to EBITDA, but they're growing at 19%, 18%, which is like almost double the growth rate of what Paysafe is growing at. NVEI is even growing even faster, 26%, 28%. But I mean, when they're growing faster, they usually demand a higher premium on the price to sales ratio. So this one's like 19. And generally, smaller growing companies, their EBITDA are very narrow, and that's why you have a high price to EBITDA ratio. RPAY, again, 9 versus 7.8, still pretty. I guess if you look at these so far, Paysafe is still relatively cheap. RPAY's price to EBITDA for 2022 is very similar to Paysafe. So you could arguably say Paysafe is fairly valued compared to these 4 so far. PAYA, a lot cheaper, not a lot cheaper, but cheaper than Paysafe at 5.84 versus 7.8. Very similar price to EBITDA ratio, growing at 16% and 15%, 16% 2021 and 15% 2022. And looking at Shift4, this one's really interesting because look how fast they're growing, 39% and 29%. Actually, from this exercise, I kind of want to look more into shift 4 just because look, they're growing at 39% and 29% in 2021 and 2022. And the price to sales ratio is like half of what Paysafe is, or not exactly half, but a lot cheaper than what Paysafe is. PE rate, sorry, not PE, price to EBITDA ratio, 28, which is higher. Again, with smaller growing companies, generally higher EBITDA. So let's look at Square. Square wasn't exactly in the comparable company, so I'll tell you which ones I compared. Where was I? Oh, no, past it. No. Oh, no. No, wait, I did. Sorry. Okay, yeah. So I kind of did these companies plus this. So these are more key comparables, what they called it. Anyways. Square is not exactly it, but I still did it. Price to sales is cheaper than Paysafe. Don't even discuss about price to EBITDA. Again, this just means that because from sales to EBITDA, there's a lot of expenses in between. So for example, sales and marketing, general and administrative. So this just says that they have Square has invested a lot of the expense, and that's why the EBITDA margin is lower. But they're growing at 35% in 2021 and 2022 growing at 19%. So maybe let's look at an average and see where they trade at. Let's do without. Yeah, I mean, I guess an average, Paysafe is cheaper from a price to sales. Oh, this is definitely cheaper. 41. I think this is skewing it way too much. I mean, to be fair, I think Paysafe is fairly valued compared to the other companies. Because of their structure and debt and using the money to pay off previous shareholders and paying a significantly higher valuation compared to what they paid previously, I personally wouldn't be getting into this one. I don't own any shares. And I have Square, and that's why I put it here. I really like Square. Great growth numbers. I really like it. High growth. Don't look at the price to EBITDA or price to earnings ratio because it's tough to look at. I would look at price to gross profit. Justin, on a couple of cents, he likes gross. He likes that ratio, price to gross profit. I do too, but it's just unfortunately the information I have, I can't strip that out unless I have to dig in each financial statements and try to like project the gross profit, but a little bit difficult. But I guess I could do that, but that's just a little bit too much work for me. So in conclusion, I don't own any Paysafe shares, and I probably wouldn't be buying Paysafe shares at this price. I mean, if they go, let's say $12, yeah, I mean, I would maybe in the 12s. I mean, I don't know if I'll ever get there. And with these SPACs, I mean, if you follow my channel, I've been following a lot of SPACs. And the SPACs are pretty hot recently. I've talked about Longview that's merging with Butterfly Networks. That one popped today. I really like that one. I got in around 15s. I was hoping to get more when it hit the 14s, but it got there maybe like very briefly, and I wasn't able to pick any up in previous weeks. I do want to add that one. I talked about Lion Electric on my last video. I really like that one. It's gotten a bit expensive, so I probably wouldn't add. But anyways, with these SPACs, I mean, I could see this growing a lot higher. But I rather buy Square for the long term, because I think, or even PayPal. I think PayPal is quite interesting. Or I even look at Shift 4 to look more in depth on what Shift 4 does, and because the valuation is cheapest price to sales and has the highest growth. So this one's quite interesting. PayPal and Square are really big companies, so I mean you can't go wrong with them. I like both of them. As longer term, like without paying too much attention to them. I mean, if you have these small companies, you have to pay like very detailed attention to them, because a small news can really move the stock price. So that's my conclusion on Paysafe. I like their business, but the valuation and growth rate, debt level questions, I decided to stay away from this one for now. I might continue to do some research on it. Maybe I'll like it one day, but at this time, I wouldn't be buying any. Let's see if there's any comments. Okay. Okay, so there's no questions. I think I will end my live stream soon. Yeah, I just checked the chat. There's not too much going on there. Thank you so much for those who were able to join. I hope you guys enjoyed the BFT Paysafe analysis. I've been requested that multiple times. I think it's a very hot one, perhaps. Maybe it's because Bill Foley or it's a fintech. Fintech is exciting. But unfortunately, the growth rate and the debt and valuation just a little bit too expensive for me, so I'm not going to go in. Thanks for staying and watching, and thank you so much for watching. If you haven't had a chance yet, please like my video. It really helps me with my algorithm. And also for those celebrating Christmas, Merry Christmas, and if not, Happy Holidays. Hope you guys enjoy the time with your friends and family, and I'll see you guys all hopefully next week. Thank you for watching.